Hi there, welcome to Kneppy Invest and welcome to another answer and reply video where I get to answer your questions and reply to your comments to the best of my ability. It is Saturday, 7th of March 2026. Time is currently 10:37 a.m. That's in Brisbane, so almost midday in Sydney, Melbourne, and that's probably it, maybe ACT as well. Okay, so probably a shortened video today, although every single time I think that will happen, I tend to go a little bit longer than I anticipate, but I am busy right now. Now, what I'll do first is I'll just give an update on my personal circumstances, and then we'll get into your questions. And today, I'll be only answering and replying to members' comments and questions just to shorten the video. Okay, so personally, what's happening to me? So technically, I start work again on Monday, although untechnically, I started work on Thursday, so I could do a fair bit of work from home. So I'm not operational because I am an operational weather forecaster, aviation forecaster, or aviation meteorologist. And I can do a lot of the non-operational stuff at home. In fact, I can do most of the operational stuff at home as well. So the reason I decided to do a little bit of work before the day I'm supposed to go back is simply because I did practical completion of my house last Tuesday. There was a possibility that I could have moved in during the week, so yesterday. And as soon as I stepped in, I went, that's not going to happen. The independent inspector was really good. So he was marking all the little errors, all the little defects, I suppose you can call them. Nothing too major. In fact, he said to me at one point, they have done nothing really silly, except one thing, which they already noticed. Probably the second silliest thing was the person who put the driveway in made a small mistake in terms of the thickness, which I don't know how you make that mistake. And the painter put the wrong hinge on the toilet door, which is really interesting. And the independent inspector actually told me that a lot of heart attacks happen on the toilet. He said the majority of heart attacks happen on the toilet. I just believed him. I should verify that. And apparently because of that, you need a special hinge on the toilet door so people can take it off or something if someone's had a heart attack. And the painter put the wrong hinge and he put the right hinge on another door. So simple little things like that. Now I thought there's no way they're going to fix all this in a few days. And I've yet to hear from him. And if I don't hear from them by Tuesday afternoon, I'm going to actually go back to my parents' place because my first operational shift isn't until Thursday the 19th, which is a night shift. And I do hope then I get a call saying I can move in at some point the next week, early the next week, or late that week. And if it's late that week, I'll just say to him, yeah, we'll just make it early the next week, and then I'll drive back and move in on that particular day. So that's where I am right now. Where I'm staying, it's actually at my ex's. She has a small place. And when I say small, I mean it's technically it's 3 bedrooms, but one is a study. And she has a lot of stuff. So the room I'm staying in, half of it is just full of boxes. There's no desk or anything like that. So that's why I'm outside. And it is a little bit cramped here. And to be honest with you, I just don't want to use up my goodwill with her, I suppose. I mean, it was an amicable breakup. Was it 5-6 years ago? Yeah. Anyway, that's where I am right now. So there's a chance that I'll be driving back to my parents' place on Wednesday. So if I do that, more than likely the ASX daily take will be a little bit late that day. Also Monday, I'm not sure what I'll do in terms of the daily take because I will be going to the office because I have to pick up a new laptop, that sort of thing. And there's a chance that I will try to record the daily take on my iPad and see how that goes. I've not done that before. Maybe I'll test it out tomorrow. That might be a good idea. Test it out tomorrow. Okay, so let's go and have a look at some of your comments and questions. And the first one is from a Scott Philpott, who says I'm honest and open and honest. Well, my style is open and honest, whatever, and your willingness to consider all stocks and their merits, however big or small. I see you're big on AI revolutionizing the way companies operate. I would say I'm bullish. And when I mean bullish, I don't mean I think it's awesome, that sort of thing, but I think it's going to happen. And I know a lot of people who hate AI, oh, it's terrible, that sort of thing. And those are the sort of people who would have said, I hate automobiles, I'm going to stick to my horse and buggy, or I hate the internet, it's stupid, I don't see any point in it. And I actually do know some people like that back in the mid-90s. What's the point of internet? Yeah, that sort of thing. There would have been people who were anti-industrial revolutionized stuff, and those people will be left behind. Yeah, so I think it actually pays to not embrace it wholeheartedly, but try to understand what is happening in the world right now. Anyway, and would have to agree we are right on the precipice. Yes, we are right on the precipice. In fact, I would say the next 5 years, the way we're going to change the way we live, our work, that sort of thing, we will not see any sort of change. We have not seen any sort of change like this in the past, because all revolutions we have seen in the past took time. It took time. It took a fair bit of time. This revolution, I think, is going to happen really quickly, and I think it is going to catch out a lot of people. Anyway, would you also say that IA will, to some degree, replace content providers like yourself, or will it complement what you're offering? This is a really interesting question, because I've been thinking about this a lot. And I am going to show you exactly why content providers like myself are under threat, just a little bit. But before I do that, I'm also going to mention that I do actually watch. Now, before I started recording videos for YouTube, I would never watch YouTube. I would never watch it. But because I do it now, release videos on YouTube, I actually do watch a fair bit of YouTube videos, not on investing, but on all these other stuff. And I'd like crime stuff, little things like that. For some reason, I like crime, murders, that sort of thing. And there's a lot of interest in that space. And whenever I come across a video that is obviously done by AI, like you have an AI voice and that sort of thing, I actually am turned off. And I do prefer human beings speaking, a little bit more natural. I think over time AI speaking will become indistinguishable from humans, but it's quite obvious at this point in time. But I just like that human content. So there is a bit of a difference between human content and AI content. At this point in time, I am more motivated to watch human content, but I think there's a chance that's going to change. But I think myself and content providers like me are under threat, because I do use AI a lot to provide information to you, and you can do a lot of stuff yourself at this point in time. And I'm going to show you exactly what I'm talking about when we get to another question in maybe 5 or 10 minutes in regards to gold stocks. I'll just show you what I did with Gemini and ChatGPT and the answers it gave me. So I do think there is a chance that, I wouldn't say we're under threat right now, but a lot of information I do provide, you can find yourself. But maybe it's just you want to just listen to me speak and, I don't know, make a fool of myself, which actually people do. People like to see other people make a fool of themselves. Okay, so that's that. I want to write down exactly when I start the new questions to make it easier for me. Kelly Ma, hi Kneppy. If I had $100,000 in my super, does Netwealth only allow me to buy $20,000 worth of shares of KGL Resource? KGL, what's this one called again? KGL, it's KGL Resources. There you go. How big is this company? Market cap 177 million. Okay. Allow me to buy $20,000 worth of shares of KGL Resources, 20% limit like Australian Super. Australian Super does not allow me to buy this company, more than likely because it's not in the ASX 300. I was a member of Australian Super, and you were limited to ASX 300 companies. And that's one of the reasons why I left Australian Super and went to Netwealth. I'm considering transferring my super to Netwealth if it allows, and 20% limit is fine with me. Yes. So you could buy any share on the ASX in Netwealth, but there are some limitations. Limitations. Limitations, Netwealth. It depends on the size of the companies. Limitations. In fact, I could just use AI for this one. Limitations of small stocks in super. Yeah, okay. Here we go. Maximum position size. Well, some large stocks are permitted up to 20% of a portfolio. Small cap or less liquid securities are generally restricted to a maximum of 5 to 10%. And so, but you can buy any company on the ASX, but you do have some limits. And as a whole, your limitations when it comes to smaller companies is something like 30% of your overall portfolio, which has not been an issue for me. So I have had zero issues when it comes to net wealth. And comparing to what happened with Australian Super, I did have issues because there were some companies I could not buy, which is, in my opinion, a little bit silly. I did not know this. For securities with last trade price of 20 cents or less, only limit orders are permitted. Did not know that. Anyway, so it's up to you whether you shift from Australian Super to net wealth, but for me, it was very positive. There's a few things I don't like about net wealth. The fees per trade still $18.50. That's way too high. Sometimes it takes a while, but that's okay. Those things are okay because for the majority of instances, I buy and sell companies in net wealth for the long term. So I don't do any trading or very limited trading in net wealth. So it's more for long-term holds. And the other very positive thing about net wealth is you can buy and hold many companies around the world. So was it 20 or 30 different exchanges around the world? Not every company on those exchanges, but the vast majority of companies that you want to buy. Anyway, so you can buy KGL resources in net wealth because you can buy any single company on the ASX. So there are some positives about net wealth over Australian Super, which is why I moved. But I did research before. This was many, many years ago. And there's probably new contenders for net wealth, competitors for net wealth. Hub24 might have their own and even better super than net wealth. Paul LY. Hi, Kneppy. Can you please have a look at MLG? Is that MLG Oz or something like that? Share price is a good value, and EQR share price was breakout last Friday with high volume. Do you think the trend will continue? So MLG, I'm pretty sure this is Oz or something. MLG Oz, yeah. Is it good value? Okay, so what I might do, because I think MLG Oz is in the right space. I'm pretty sure it's a mining services company. Maybe it's a little bit more broad than that. But why does that not work sometimes? But if you go to FinChat or anything, you can find what it does. Provides mine site services in West Australia and NT. It's a mining services company. There you go. If you just have a look, the very basic metrics for this company. Now, one thing I just mentioned is, this is just my opinion. And this is how I view companies within this space. And this is by my own determination, using my own rules, that sort of thing. I do not consider any sort of company like this to be high quality because they're way more cyclical. And if we see the complete opposite to what's happening right now, where we are still seeing a bit of a mining boom, if we see the complete opposite, this company will be severely negatively affected. And that's sort of obvious. It's a mining services company. And if mining is going through some tough times, well, mining services is going through some tough times as well. The last time we saw this was in 2016, when quite a few mining services companies went that sort of thing, including a company I owned, by the way. The only company I've ever owned that went bankrupt. Anyway, that's a whole different story. It was a drilling services company. Anyway, but this company mining services company, any mining services company, a lot of tailwinds behind it. And the way I look at these, good short-term trades or medium-term trades and just ride the mining boom. So year founded 2001, so it's been around for a while. Anyway, so P ratio 13.2 seems pretty low. Revenue growing nicely. Now, I'm pretty sure this company listed, does it say where it's listed? I don't know if it does. In fact, if we go to Market Index, usually Market Index says where it listed. It used to. I'm not sure if it does anymore. It used to say when it listed. 2021, 4th of May 2021. There we go. I'm not sure if that's always accurate. But what you can also do is just go back in the announcements and go all the way back. And we've lost the announcements. Oh, there we go. Yeah, there we go. April 2021. ASX market release, admission and quotation. Yeah, there we go. So it's been around on the ASX for nearly 5 years. So if we go back to Fiscal AI, it's grown revenue pretty nicely. Now that is revenue growth, not revenue per share growth. And I do prefer revenue per share growth, but earnings per share over the last 3 years up 27.8, but over the last 5 years down at 2.2%. Not sure why. So I'd like to investigate that. The other things I look at, I don't expect operating margins to be high. They're not at 5.3%. That's another reason why I don't consider these companies to be high quality, because really low operating margins are really tiny. And if things turn a little bit bad for these type of companies, those low margins will really affect the profits of these companies. Gross margins 34.3%. Return equity, return invested capital, 5-year average at 5.8 and 5% respectively. And straight away, that is not a high quality company. So now that's a 5-year average, and maybe it's been increasing. Also, like just to have a look at the, there's revenue. I also like to have a look at historical numbers, and you can just see by the revenue and profit that this company is low margins, and they haven't really increased their profit over that period. We already knew that. So even though the revenue has been growing nicely, haven't increased their profit. That is a red flag for me. And the other thing I just want to know is shares increasing. Now, initially there was nothing because it was not listed. And the reason we've got information for 2018 and 19 and 20 is because when a company lists on the ASX, they have to provide historical financials. So that means the last 2 or 3 years of financials. That is why financials go back to 2018. But shares on issue have increased a little bit. Maybe they made an acquisition when they listed, but they haven't really been diluting shareholders. So the main concern here is actually decreasing margins. So what do you also look at is just have a look at margins. Oh, did I go past it? No, there it is. I'm just going to have a look at operating margins and maybe EBITDA margins, and I'm assuming there's a bit going down. Yeah, they've been dropping a little bit, although they have been rising in the last few years. Yeah, so maybe the company's been becoming a little bit more efficient recently, but not a high quality company. So in my opinion, this is more of a trade. So I'll have a look at the chart in a second, but your question was around a valuation. So it does say the P ratio is 13.2. Now the valuation or markup of the company is 155.75. And because the tailwinds behind this company, there is a scenario where this company increases a profit to a high level with increasing margins to the point where it looks cheap, like a P ratio of 8 or 9. And then it does look cheap, but all it needs is one bad year and the profits just plummet, and then it looks expensive again. So I don't know if I would look at valuation like the P ratio of a company or this sort of company and determine whether it's cheap or expensive just on that. And we've seen that in the past with companies like this. They look expensive, but in fact they were cheap because they could have had a few bad years where the profit was suppressed, and then the profit goes up 5-fold in a few years because times are good again. So even when the P ratio looks high, the company could be good value. And if the P ratio is low, it could be a little bit overvalued, if that all makes sense. Anyway, so for me, this is more of a trading stock. And I have a feeling the chart might be looking okay. Yeah, this is actually a pretty good looking chart. In fact, if you have a look at the weekly chart, so the share price is still not to the levels it was when it listed. So for the first 2 years it was listed, the share price collapsed. But since then, share price has been in an uptrend. And I think the main reason behind that, it's in the right space. Nice breakout, probably June of last year at around 68 cents. I'd like to see it get above $1.08 because that is a nice little resistance level. But, and the volume increasing as well. If you have a look at the weekly chart, we have seen a subtle increase in volume. So that's nice as well. So I don't mind the chart and I don't mind increase in volume, but I would not classify this company as high quality, and I would not buy this for the long term. And you also asked about EQR. Spent a little time on MLG. EQR share price breaking out. So I am trading EQR. And the valuation of this company just keeps on going up, 1.57 billion. This is a tungsten. Lots of interesting tungsten right now. And look at that volume. It's a brilliant volume. So this company broke out back in October. And look at that volume just increasing. So sudden increase Well, technically, it started to really increase probably July, August. There's a bit of a dip in August, but then a big increase in September, even though the share price was going down. So that could be a sign that another example of volume leading the share price. So volume increasing before share price does. I've seen this quite a few times now. And then the share price broke up on even bigger volume, and that was a time to get interested in this company if you're following it at 4.5 cents. So it's almost a 10 bagger since then. And the share price just keeps on going up. I took profits at 18 cents just because I was thinking, oh, the share price is going up exponentially. But my previous problem then is the share price went sideways for about 2 weeks. And that's actually a good sign. And then the next leg up. So this is actually a gorgeous chart, and I have no intention of selling it, even though market cap looks really high at 1.57 billion. So I probably should have a look at this company, how they are in production. So this is why the valuation is interesting to me. They are in production, and they do have cash flows. Well, it could be positive now. I'm pretty sure it was negative up until the last, where is it? There it is. So this company does release the pennies 5B. They talk about tungsten, how it's increasing, and it's very positive for this company, which is a no-do. And this is another example of there's a lot of tailwinds behind this company, and the vast majority of those tailwinds is just the underlying commodity. So receipts 21.8 million, and company was operating cash flow positive, but not free cash flow positive. But if tungsten prices keep on going up, this company will see some leverage from that. But the opposite is true as well. So you want to see tungsten prices keep on going up. And it is difficult to follow tungsten prices. So I've shown you this chart before. There's no tungsten in TradingView. If you don't believe me, let's have a look. Tungsten. And if you have a look at futures, nothing. Yeah, so all these tungsten are just companies like Tungsten Mining, TGN. So the way I look at tungsten prices, I haven't found any good alternative, but what's it called? Business Analytic. They have a lot of charts in here. And we'll have a look at which one shall we have a look at? I think tungsten price. So this has you just said the tungsten price going up. Yeah, this is my favorite one because it has a lot of different prices here. Tungsten prices have been going up, but how's it going to move in the future? That's the thing we don't know. How's it going to move in the future? Just because it's been moving up and for the last year or so doesn't mean it's going to keep on moving up. This could be the high. So that is why I do get a touch nervous when I am trading mining companies, because all it takes is a little bit of a shock and then the price of the commodity starts dropping. And I suppose that's when you sell. But for commodities like tungsten, where it's actually harder to find charts, it's a little bit tougher because I do look at most commodity charts in TradingView, but I don't do that if they're not in TradingView. But the chart for tungsten it's a chart to study. Paul Lee also says, hi Kneppy, if oil prices continue to rise in the coming months, do you think Doug share prices will be going up because the company provides software for oil companies? Okay, interesting enough, I noticed before I went to EQR, Doug was in this. And I was trading Doug. I got out, and I'm thinking of getting back in. I don't know whether the share price dropped here. I was a part of that drop. And then, yeah, so I might get in. I don't like the lack of volume. Their results were okay. They released those on the 26th of February. But we haven't seen any sort of follow-on action, and the volume has been quite light. But I thought the reaction or the results were pretty good. I suppose better than I expected. Anyway, so when it comes to oil, I haven't read this yet, but in AFR, will bring down world economy, market fear surges as oil shock begins. So there's a chance that if this happens, and this is the Qatar energy minister saying this will bring down economies of the world, he's actually saying oil price could spike $250 a barrel. He believes that most Gulf producers will be forced to shut off production within days, if only to avoid legal liability for contracted shipments. And oil price could spike to $150 a barrel. Who is going to be the most hated president in history if this happens? Donald Trump. And that is why I don't think this is going to happen as he portrays here, because Donald Trump, I do believe he has lower self-esteem. He wants to be liked. And he does follow the market, and the stock market. And whenever the stock market plunges after one of his policies, he turns his back on it. Trump always chickens out. There's that saying for a reason. And one of his major platforms in running for presidency was lower oil prices, so lower petrol prices at the pump. And this will be the complete opposite. And a lot of his supporters will turn against him, in my opinion, if this happens, if we see increasing oil prices. And to be honest with you, this is really negative for the world at large, because we are still overly dependent on oil. I think this will change over time, but it's going to take time. Now, this sort of thing, this sort of impact could lead to a quickening in the change where we become less and less dependent on oil. And I think that's very positive for the world. And in fact, I wish countries like Australia did this earlier, so the impact would be significantly less. Because if oil prices do reach $150 a barrel, everything will become more expensive. We will see inflation. And this is exactly what happened in the 1970s. This is why we had stagflation. So there is a chance that if this happens, that this will be highly, what's the word? What's the opposite of beneficial? Highly detrimental to world economies. I do believe this is true, but I think this is just one scenario. And I do have trust in Trump that he'll see this happening and he will backtrack. I don't know how. He seems really intent on changing of making Iran. What did he mention? He wants Iran to surrender. He's not going to stop until they surrender. But who knows? This could be protracted for a while, last a little bit longer than I think. Anyway, on to Doug. Could Doug be benefiting from larger oil prices? Yeah. Or the other thing I noticed is, we'll have a look at oil prices overnight. If I can find it. Oil up 15.72%. That's not looking good, is it? So oil was looking really good before this. And I think this was one of the reasons oil started to look good, is because we saw increasing military presence, or United States military presence, in that area of the world. And I think very smart people were going, yeah, I think there's going to be an oil shock. And I thought this particular, this war would not last long. That is what I thought. But oil prices up 15.72% overnight. Well, maybe not overnight, but in the last 24 hours. Which means Woodside, a lot of oil companies are going to benefit. Anyway. And Doug, maybe Doug will see. In fact, what I will say, I would think Doug technology would benefit, but the best way to really know if it's going to benefit is to see how the market reacts. If the market doesn't react, then the benefits to Doug technology may not be as strong as what you may think. But if it does, if you see a share price break above 220, I think there is an argument, particularly on Monday. If we see the share price rally significantly on Monday, I think there is definitely an argument that, hey, Doug technology could be a beneficiary of rising oil prices. Okay, here it is. SAF 99681 says, a video on what you would consider the best value gold companies, maybe a couple of producers and a couple of explorers, would be interesting. And then Kelly Ma says, Minerals 260, Ballard Mining, Benz Mining. Don't know much about those companies. And this sort of exercise could take someone maybe all day, because you have to go through every single gold company. Really, you do have to do that. You have to look at all the different sort of metrics, like all-in sustaining costs, production, mine life. And then you have to also take a view of, I suppose you don't really have to have a view on the future gold prices, because you can make that constant for all companies. But when it comes to exploring companies, you do have to take into account how long before they're into production, that sort of thing. So it's sort of the project that would take all day. Then comes along AI. So I'll just show you what I did. I saw this question and I thought, I saw that other question earlier from Scott Philpott, and I thought this is a really good example of what you can do yourself. So all I did was ask, by the way, Gemini, the paid version is, last time I looked, it wasn't working. In fact, what I might do is I'll put my prompt and apparently they are transitioning or doing something, and we'll see if it's working now. Yeah, so I seem to be counting an error. So according to something I was reading, there is a transition in Gemini right now. So they're transitioning from some sort of old system to a new system. But fortunately, the non-paid version is working. So all I did was a prompt, and I would not call myself someone who knows how to do prompts. I'm learning, and this is the key when it comes to AI, is knowing how to prompt. And it's really interesting that people just start using AI without learning anything about it. But why would you do that? Did you do that with a car? Do you do that with anything? You just start using it without learning how to use it. So I think it's very important to know how to use AI. And I am still, well, I've got a lot to learn. And I'd say I'd give my prompts a D at this point in time. I want to get to at least a B. And I say the majority of people probably do F-type prompts. So in terms of grades. So this is my prompt. I'm a fund manager focused on mining companies, analyze all the gold stocks in the ASX and list these from undervalued to overvalued for producers and also for explorers, separate the two, explore risk rewards for all companies, explore only stocks listed on ASX, March 2025. I would like a comprehensive list of at least 50 stocks. So this is the non-paid version of Gemini. I do pay for Gemini. I also pay for ChatGPT. So here we are. It just gives you a little spiel. As a fund manager in the mining sector, you're navigating a fascinating period for the ASX gold space. By March 2025, the gold price has sustained record highs, etc., etc. The market has shifted from a risk-off defensive stance to a margin expansion hunt. Below is a comprehensive analysis of over 50 ASX-listed gold stocks, categorized and ranked by the valuation and risk-reward profiles as of early 2025. Gold producers undervalued to overvalued. Initially, when I did this prompt, so I suddenly changed it. It only gave me 5 companies. So I wanted more. So you do have to tinker with your prompts to get what you want. So for instance, it's saying that Kingstate Consolidated is the most undervalued. Trading at a 0.38 price to NAV, expansion at Cettire is driving a free cash flow inflection, highly sensitive to grade increases. Then we have Westgold Resources. Another reason I had to change my prompt is because I put a few companies in there, like De Grey Mining, which has been bought out, which was a little bit annoying. Anyway, so got Westgrade Resources, post-merger with Karora. The scale is massive. The other thing I should mention is I wouldn't absolutely believe all the information it gives you. Yeah, so that's why prompts are really important, because if your prompts are weak, it can hallucinate and give you some weird information. That's why prompts are really important. Anyway, so Resolute Mining, deep value play, but carries heavy African jurisdictional discount. Strong cash flow from Siama, but regulatory uncertainty remains a drag. Perseus Mining, another African one, cash cow of Africa. Regis Resources, historically weighed down by the McPhillamys regulatory hurdle. Valuation is attractive if the market looks past the legacy issues to their WA cash flow. Vault Minerals, and then also Orabanda Mining. Okay, so that's the value tier. Then they have the fair value tier. So Emerald Resources, Ramelius Resources, Genesis Minerals, Bellevue Gold, West African. I thought that would have been in the value tier. Says exceptional grades in Burkina Faso. Risk is purely geopolitical. If West Africa stabilizes, this is a multi-bagger, and actually I do agree with that. Bellevue Gold, now a stable producer. Reward comes from organic growth and resource expansion. Valuation is healthy, but not cheap. Then you have premium overvalued here. So Northern Star. I like how they put here the reward risk. So for instance, Kingstate is high reward, medium risk. So Regis is medium reward, low risk. Perseus, medium reward, low risk. And yeah, West African, high reward, high risk. Okay, so I understand that now. And then for these premium overvalued tiers, Northern Star, low reward, low risk. The industry benchmark growth at KCGM is well understood. Safe but limited. Alpha unless gold hits 3,500. So we also have Evolution Mining, Capricorn Metals, and Newmont. So some of the biggest ones are in the premium overvalued tier. Other producers for your list, Alkane, Pantoro, Catalyst. I would have liked to see some more information on those. So then you can do another prompt. Also got Kaiser Reef, Go Kaiser Reef, which is a company I own. Gold explorers and developers, high risk, high reward. So the market currently is rewarding size, scale, and grade, all in same cost protection. We categorize these by their project maturity. So there we have De Grey Mining. So even though I mention only companies listed in March 2020. Oh, did I say 2025? That's probably why. This should be 2026. Okay. So I wonder if I do this again. So it's a lot of people complain about the responses from AI, and a lot of that is just user error. Why is that not? There we go. Let me just start this again. New chat. Oh, I don't know what's happening. Something went wrong. Looks like these issues are now with, yeah, even Gemini, the non-paid version. Okay, so let's go to ChatGPT. So this is, again, I made a little mistake. I said March 2025, limited to companies they're listed. So again, this isn't my mistake. Now this I used in ChatGPT 5.4, they've upgraded. I use the thinking model, so it takes time. It thinks about it, but a lot of really interesting stuff here. So it gave me exactly what I wanted. What I'm going to do is I'm going to do it again, but put March 2026 and just see if it changes it. Now this is going to take time because it's in the thinking mode. Okay, so let's just see what it says. So it thought for 2 minutes and 44 seconds. Below is a relative value of 56 ASX gold names that were listed by March 2025, split into producers and explorers. I'm not claiming this is every microcap in the full March 2025 gold universe. Is a broad investable screen with more than 50 names you asked for, excluding obvious non-gold dominant names and post-March 2025 entrants. Okay, so it keeps on going. My ranking is not a target price model. It's a fund manager style relative screen using cost position, jurisdiction, balance sheet resilience, mine life, growth runway, takeover optionality, and how much of that is already in the share price. In a strong gold tape, the biggest trap is paying top dollar for good stories whose re-rating has already happened. So, undervalued to overvalued. Remilius. So, reward, margin expansion, and corporate optionality, risk, WA concentration, and merger and acquisition overreach. Best mix of low cost ounces, operating credibility, and still reasonable market expectations. Then it has West African. So I do own West African, and one of the reasons I own West African is because I think it's really cheap. Strong operating cash engine with less hero premium than some domestic peers. And it does mention Burkina Faso sovereign security risk, which is, in my opinion, the only risk. If this company was listed on the ASX, I would say the share price would be more than double what it is now. Perseus, another African producer, and so market often discounts Africa even when operations are strong. Yeah. Then we have Emerald Resources, Gold Road. Hasn't Gold Road been taken out? Yeah, so again, yep, Gold Road's been taken out. So again, this was just an error in my prompts. Pantoro, Orabanda, Catalyst Metals, Kingsgate, Vault Minerals, West Gold, Genesis, Capricorn, Northern Star, Evolution, Resolute, Bellevue. So let's go all the way to the bottom. And then at the bottom, we have a number 22, Savannah Goldfields, which is a fairly small company, if I remember correctly. I haven't had a look at this in the past, but I had not been attracted to it. So this company has a market cap of 32 million. Let's see what it says. Not enough margin of safety for operational risk, and reward any sustained operational improvement, risk persistent underperformance. We also have Kaiser Reef, which I do own. Micro producer torque can be huge, but so can operational fragility, material rate if production base scales, size, liquidity, asset concentration. So this might have changed. And then we get into some explorers and developers. So according to this, predictive discovery is the most valued here. So reward corporate action project de-risking, jurisdiction and financing path is the risk. Then we have Astral Resources going down the list. So quite a few companies here. Lots of companies, in fact. So my highest conviction names, if I were building a gold sleeve today, Remilius, West African, Perseus, Emerald, Gold Road, Pantoro, Orabanda, and then Predictive, and then a few other explorers and developers. The biggest names I think the market is already paying up for: Evolution, Northern Star, Capricorn, GMD on the producer side, and a few companies on the explorer side. That does not make them bad companies. It means the future is already more heavily capitalized into the share price. And then always ask a question. If you want, I can turn this into a fund manager style scorecard with columns for jurisdiction, ASIC cost, position, balance sheet strength, development risk, takeover optionality, and 12-month re-rating potential. It's one of the things I do like about GPT. It does ask you further questions. And one thing I actually learned yesterday is you should ask it questions in terms of what are some of the questions I can ask you? No, what are some of the questions you can ask me to get a better understanding of me and my own questions? Something like that, which I found really fascinating. Anyway, so let's see if we change the date to March 2026, if it changes its thoughts. And you see it's a little bit different what it's done here. So it's a little bit different, even though I just changed the date, that's all I did. And it's actually listed undervalued. So Romelius, West African, Perseus, Emerald, Gold, Rose, Road. Again, it's made a mistake there. You also mentioned here, FRS is included as an emerging producer because it announced an all purchase agreement marking its transition to producer status in February 2026. All right, so yeah. And it says Bellevue Gold is the most overvalued in producer set. Great asset quality, but still too much value rests on a smooth operating outcome. And then producers. Yeah, there we go. Lots and lots of producers. Anyway, so this is what you can do when it comes to AI. And this sort of thing would save you a fair bit of time, particularly once you become more competent in learning how to put the right prompt into AI. And I'm starting to do this more and more. I do think it's a slow process, but I think it's going to be very beneficial for you if you start to learn how to use AI. It will lead to a more productive life, in my opinion. And I think you can get a lot of ideas. So just by doing that simple thing I did with gold companies on the ASX, I've already learned a little bit. Make sure you put the right date in. Okay. Kitty Thomas, Cettire, has a material uncertainty related to going concern, a formal auditor's warning. Thoughts? So let's have a look at Cettire. Okay, so I consider Cettire to be more of a trading stock. And you can tell that by just the chart. You just want to be trading this. You don't want to be owning this. It's just too highly volatile, and it's not the company with the best moat. Put it like that. It's not even in the top 90% of companies with a good moat. It's maybe in the top 98%. I don't know. Anyway, so if you have a look at the Appendix 4D, so what a company usually puts into the notes is going concern. So if you go to the notes, whoops, it's usually at the top. So note 1, note 2, there he is, going concern. Okay, straight away, I noticed this is from the company and it's counted itself. So the half report has been prepared on a going concern basis. This contemplates continuity. Sometimes I have to think about how to pronounce the word. Continuity of normal business activities and realization of assets and settlement of liabilities in an ordinary course of business. Now, I have not had a look at the financial statements, but straight away, they mention a net current asset deficiency. And straight away, that is a red flag for me. Let's have a look at their balance sheet. Yes, so total current assets, 77 million. Total current liabilities, 128.6 million. So it was about 5 years ago where I saw this, but not as but a little bit more extreme than this for a company called, oh, what the hell? Mosaic Brands. That's it, Mosaic Brands. It's gone bankrupt now. And I was trying to get answers because that company had significantly higher total current liabilities than total current assets. And I thought, hey, this is a this looks like a massive red flag. Is it a red flag? I was trying to get answers. And in fact, I probably could do that now with ChatGPT or Gemini and give this sort of financial statement, just put it in and just ask with the right prompt in regards to current assets versus current liabilities, because I was researching this for ages. And I did discover at one point that high turnover companies, it's okay if total current assets is significantly below total current liabilities. It can be okay with a high turnover company. So the question becomes, is Cettire high turnover? Because to see total current assets 77 million and total current liabilities 128 million, that looks a little bit ew. And the one here is trade and other payables 110 million. Trade and other receivables 8 million. And if you compare to last year, so the company did have the same problem, but total current liabilities have exploded, have gone up 33%, and trade and other payables have gone up a significant amount. In fact, 27, 37, gone up 50% since then. And trade and other receivables have gone down. They do have a fair bit of cash, $61 million of cash. So also take that into account. So I'm wondering if they were are able to. That's a lot of trade and other payables, 110 million. So that's going to be interesting. So I can definitely see this could be an issue. So I just want to go back and see what they say, because they will mention, this is no issue. Now, they did generate $37 million in operating cash flow. So that's pretty good. It's pretty good. It's a fair bit of cash flow. So let's just have a look to see what they said. And they mention net current asset deficiency. They also mention the loss, which I don't really care about. They also mentioned, okay, so the net current asset deficiency and the net loss after tax for the current period gives rise to a material uncertainty in the relation to going concern that may cast significant doubt on the group's ability to continue as a going concern. So in fact, the company even mentioned it, and to realise its assets and settle its liabilities in the ordinary course of business. I thought they were going to downplay it, but they've actually said, this is a little bit of concern. Despite these material uncertainties, okay, so now we've got a despite. I thought maybe it could be however. Despite these material uncertainties, the directors have considered the performance and position of the group and considered that the going concern basis is appropriate for the preparation of financial statements due to the following factors. Then they talked about the operating cash flow. The group had net assets and they had a fair bit of cash. So let's go back to overall assets. I don't really care about that because a lot of their assets are intangibles, which is BS assets, in my opinion. So in this case, meh. They also have a lot of non-current trade and other receivables. That's interesting. That's interesting in itself. Anyway, so they're saying cash flow is one of the main. What was the other main reason they said? Oh, the net assets and cash. Okay, yeah. Net assets, I don't really care about that, but yeah, operating cash flow looks good. The group has a supportive working capital cycle whereby customers pay upfront for purchases and the group utilizes the credit terms provided by its suppliers. Including current liabilities are contract liabilities of 16 million representing customer advances that would not be paid out, but rather recognized as revenue. Interesting. Okay, so they are downplaying it. And their assessment that the company's ability to continue as a going concern is supported by cash flow forecast covering a 12-month period. Okay, but that is the company itself. Now, if you go down, there should be, and I'm assuming this question, formal auditor's warning. I'm assuming there is an auditor report on this. There we go, independent auditor, and they will have a reply to the going concern. Okay, here it is. Material uncertainty related going concern. We draw attention to note 2 in the financial report, which indicates the group incurred a loss, whatever, And as of that day, the group's current liabilities exceeded its current assets by 51.6 million. As stated in Note 2, these events or conditions, along with other matters as set forth in Note 2, indicate that a material uncertainty exists that may cast significant doubt on the group's ability to continue as a going concern. Our conclusion is not modified in respect of this matter. Okay, so they're just sort of agreeing. It's a risk, I suppose, but I wouldn't be overly concerned just now. But I have seen this in the past now, where a company's current assets is significantly lower than the current liabilities, and it does lead to problems in the future. And I'm going to actually ChatGPT this or Gemini this, because it was a question many years ago I had, and it's now come up again. And I'm going to see if I can get better answers, because I did not get any good answers that I thought were acceptable. Okay, so you might notice that my screen or my insert, or whatever you want to call it, is now on the bottom left. So people are complaining about me being in the top right. So top right of schools topping charts. So I vote for bottom left. So this is from Michael at DJ. So quite a few comments in relation to this. Now, if I get complaints again that it's in the bottom left, I've already tried bottom right, top left, right. Now, if I keep getting complaints, probably the best thing to do would be to take my insert out for periods of time. And here's another one. Yeah, could you move your head to the bottom right corner so we can see the chart, please? So, so someone's saying put in the bottom right, but I think that also obscures stuff. I don't know why I put in the top right. I think someone said put in the top right. Now, I'm going to just leave it at the bottom left. So if you have any more suggestions, come back to me. Okay. Ben Hutchinson, I thought Vysarn drop was due to insider selling on Friday. There you go. I don't typically follow insider buying and selling, and this could be one of my weaknesses. So I should be paying a little bit more attention to it. And I'm pretty sure there's a lot of stuff out there where you can follow insider buying. And I'm pretty sure I could just do this in ChatGPT. It could give me output every single day about who's buying and who's selling. And I'm pretty sure if you could do this in Market Index, I would, here we go, director of transactions. There you go. So I'm pretty sure you can do this for every company pretty quickly, Market Index. And just look at this. So I really try to focus on on-market trades. So for instance, a few directors are buying Iris, Visa. This could be bullish, and quite a few are buying Visa shares. That could be fairly bullish. And no one's selling. There we go, Aussie Broadband. Someone sold on market trade. Anyway, so let's have a look at Vysarn. And there he is, 27th of February. So the share price plummeted one particular day. And this would make sense. So was this the... So the share price went up significantly on the 27th. And then plummeted the next day. Let's have a look. Yeah, that's really interesting. Really bullish candlestick on the 27th. The share price initially did drop and then it went up and then it dropped the next day. So just by looking at the chart, nothing untoward happening with Vysarn, although the volume is spectacular. The growth in volume is amazing. Now, I am a holder of Vysarn now. For the longest time, I wasn't the holder. I was a holder for the longest time, and then I was a holder for a long time. So I bought Vysarn 2023, I think, and then I held it for a long time. Then I took some profits completely, probably in start of 2025. Then I bought back in, and it's in my super now, so I'm not trading it. Anyway, so if we go back to this 27th, so there was a change of directors notice at 4:27 p.m. Okay, so this is after trading began. That's probably why. Wait there, it doesn't say. Oh, it does. Disposed 4.2 million shares. Off-market trade. Okay. I wish they put the share price here. Okay, so that's probably a good reason why the share price might have dropped the next day. But yeah, it was down 9.2. But in the broad scheme of things, and that's probably why the volume was pretty big the previous day. How many shares did he sell again? 4.2 million. And that particular day, there were 5 million shares traded. So I would say the vast majority of, although it was off market, don't forget about me. Anyway, so I do not panic. I do not think it's a sell when I see one director selling a few shares. Now, this could be a fair bit. I think it was a fair bit. Oh no, it's like 40% of his shares. Still holds a fair bit. I do get a little bit nervous when we see a group of directors selling at the same time. And the main reason behind that is research shows that is a red flag. Research shows that when one director sells, not many shares, that's not a red flag. In my opinion, this is not a lot of shares. It's not like Drone Shield directors selling completely out. Twice, I think they've done that now. But when you see a group of directors selling quite a few shares, that is a red flag. Research has shown this. So A2 Milk, this happened to A2 Milk about 5 years ago. Share price, they released results, then they all sold out, not completely, and then the share price went down, 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 and then they issued 4 downgrades in less than a year. But you're probably right. There was a bit of insider selling on late on Thursday, and the share price dropped, and the share price, if you see it, it's recovered back up. Again, this is people panicking because, maybe not panicking, but they're selling because, director sold, the company's in trouble. But there's no signal. There is actually no signal when it comes to directors selling like this. But there's actually a much better signal when directors are buying. So I'm more likely to pay attention to directors buying. Ben Coleman does ask if I can include EQR in my next video. Well, I've already included EQR in this particular video, haven't I? I've just talked briefly about EQR. So I think we can move on. Ben Coleman. Designation 8 does ask, next investor in the latest email newsletter at 9:30 a.m. said OD6 Metals is the next pick and the share price doubled at open today. Okay, so this is OD6. So OD6 was my stock of the day on, which day was it? Was it Thursday? The 5th. What was the 5th? That was Thursday. And yes, I did see later in the day, I saw an email from Next Investor saying this was their pick. And it coincided with the announcement from the company. Oh, no, maybe it was the 4th. It must have been the 4th. Let's have a look. Yeah, the 4th, sorry. So this coincided with an announcement the company released, OD6 to acquire ultra-high-grade USA fluorspar project. And I'm assuming, maybe not assumption, I would think that 50 to 60% of the share price increasing was because of the announcement, and maybe 30 to 40% of the increase in share price was because of Next Investors. So I do think the share price is up, would have been up less than 68.52% if Next Investors didn't release that little recommendation. So it does help Next Investors manipulating the share price. Again, I say that in a joking fashion. Fishball is loving Reliance Worldwide Corporation. Couldn't help myself but take a position from Worldwide Reliance Corporation. No threat from AI, just bad sentiment, just Reese, although Reese and James Hardy, yeah, they did experience this and they're coming out of it. No threat from AI. I'm going to say something controversial now. Every single company, organization, even person is under threat from AI. Not exactly AI, but a combination of AI and robotics. And when AI and robotics will collide, and they will, we're going to see AI and robotics come together. That is when every single company, every single job in the world will be under threat. Every single one. And I've been thinking to myself, which job will go last? I have the feeling it might be athletes. I have a feeling it might be athletes. I don't know. Maybe runners, swimmers. We want to see runners and swimmers. Maybe we'll always want to see runners and swimmers trying to outcompete each other. Anyway, so every single job is under threat. Every single job. Yes, there is a possibility humans will become obsolete. And then the question becomes for all of us, what is our purpose? And I'll be honest with you, I've transitioned already. I'm trying to find purpose outside of work. And I think that's very important. What do we find useful? How do we find ourselves useful outside of work? And I just think that work becomes such a big part of our lives. And a lot of people work 5 days a day, 12 hours a day. It's their lives. And that sort of lifestyle is under threat. And over the past year, when I've been on leave, I've enjoyed not having to think about that. It's been a pleasure. Anyway, so let's have a look at Worldwide Reliance Corporation. First thing I'm going to do is just have a look at the company itself. I have and ahhed about Reliance Worldwide as a high-quality company. I think it's probably on the precipice. Second time we've used that word. It's close, but maybe not there. And I think the main reason I'd say it's not there is the lack of significant growth in this company. In fact, this company listed maybe 10 years ago. In fact, let's have a look. Maybe over 10 years, maybe 11 years ago. Let's have a look, go all the way back in announcements. 2016, almost 10 years ago. So April 2016, this company lists. So we have almost 10 years of history, don't we? Anyway, so a very little revenue growth. Well, 14% over the last 10 years, but only 0% over the last 3 years. And earnings per share growth, 1.4% over the last 5 years, negative over the last 3 years. So this company has been struggling. Gross margins, operating margins. I prefer the operating margins to be a little bit higher. And return on equity, return on invested capital, too low. Return on invested capital, 5-year average of 7.8. And in fact, if you have a look at the chart for Reliance Worldwide Corporation, it's not the chart of a high-quality company. Some of the metrics in the past, in fact, the share prices, the company could be getting to the point where it's just looking attractive. Yeah. So at about $3, if you go and have a look, just put a line at $3. And have a look at all the times it's been below $3. It's been below $3, not that much, back during COVID-19, and then briefly back in December 2022. Share price has been as high as $6. So if you just have a look at the last 10 years, this has been a trading stock, and you buy at $3 or under $3, and you sell when it gets to above $6. So we'll put a line at 3 or a line at 6. And right now, this company is at $3 just based off this, without even looking further into their any sort of their financials. Where is it? Here it is. So it says the PE ratio is 16.8. And what I'll do is I'll just have a look at the financial history. Oh, we can actually. Oh, okay. We've already got the financial history because I was looking at another company. So what we'll do is we'll get rid of view. There's one thing I do like about Fiscal AI now is if you're looking at some metrics of one company, you can go to another company on the same exchange and see how the metrics look for that company. Anyway, so nice growth in revenue, and income has been sort of flat over the last 5 years. And sort of revenue growth has been sort of plateauing as well. Shares on issue have been dropping. So maybe they're doing a share buyback. Are they doing a share buyback? Which would actually make this company even more attractive. Let's have a look. Are they doing a share buyback? It would not be surprising if they are. There we go, share buyback, yeah. So they're doing a share buyback. I'm just going to have a quick look at the results. Very quick look. I think this was not a disappointing, but it wasn't that wowzers. And they're talking about challenging it straight away. Sales down 4.6, profit of 43.7 million in US dollars. Adjusted net profit after tax, 52.2, down a fair bit, and $21.2 million of cash generation. Okay, so I do think eventually the bottom will be in for this company. Now I'm just going to have a quick look at margins. They haven't really been dropping, have they? Just fairly similar margins since 2017. And the last thing I'm going to look at is just, we'll have a look at PE ratio. We'll have a look at that. We'll also have a look at price to free cash flow, or maybe free cash flow yield. And we'll have a look at EV to EBIT. We'll have a look at those. In terms of valuation, So free cash flow yield looks really interesting. So it's high levels, about 11 to 12%. It's been at these levels for a while. We'll get rid of that. And we'll have a look at EV to EBIT. What we'll do is just have a look at the last. Oh, why can't I change the dates here? Here we go. Just going to have a look at the last. Yeah, there we go. So EV to EBIT is at low levels. If it gets to about 10, which is a historical low for this company, so it's near that low. And the other one I want to look at is P ratio. P ratio has been, well, got as low as 10.8 in December 2022 and 11.5. So it's 16.9. So if you do think the worst is in and you're going to see a nice rise in profit, right now could be a good time. I do like the very fact the share price is right above $3, which has been a nice support level for this company, or a good time to buy this company over the past 10 years. So yeah, Reliance Worldwide Corporation, looking maybe okay. Maybe not the performance, financial performance, but in terms of valuation and just the technicals, yeah. But there could be more to fall. Designations 8. Could you analyze last 15-month chart of BE, Bloom Energy, and if it's still a potential buy? Also 268A, Rigaku Holdings. So BE, just last 15 months. Interesting. Well, I don't think we have to look at the last 15 months. Just have a look at, well, that's a weekly chart. All we need is have a look at the last, is that 9 months? For some reason, share price dropped a lot, 15.5% on a Friday. Don't know why. This company has a market cap of 37.9 billion. What do they do? So it's a pretty big company. If this company was listed on the ASX, I would know all about it. Gauges in the manufacture and installation of solid oxide fuel cell-based power generation platforms. Its product, Bloom Energy Saver, converts standard low-pressure natural gas or biogas into electricity. Interesting. The share price has gone bonkers in the past 9 months, from $20, $30 up to $150. This big down day on a Friday, I probably want to understand what happened. Did anything happen? Just a bit of profit taking. We saw a nice little pullback back in November, December. Share price did pull down 50%. So these sort of upswings in the share price, uptrends, you can on occasion see significant pullbacks. And we saw that with Bloom Energy. So we might see this could be the start of another pullback. Technically, if the share price fell below there, so this little line there, that would be sort of a negative sign, but it's still above the moving averages. So I wouldn't be panicking just yet and completely selling out. But if it fell below that level, if I was trading this, I'd probably maybe sell half or a third, because that would be a little bit of negative signal. That's just me, if I was trading it. And the other company was, in fact, what I'll do here is 268A. Rigaku. Okay, so I do like this chart. I like the volume as well. Really big volume coming in February. So I'm not sure what's happening with Rigaku. Market cap is 408 billion. P ratio 36.46. Dividend yield. What do they do? Manufactures and sells scientific instruments focused on X-ray technologies. Founded in 2020. Is that right? This company has gone from, in 5 years, has gone from nothing to a market cap of 408.09 billion. Listed October 2024. This chart is really, it's a really good chart. The breakout occurred on the 5th of December last year. Share price up 11.87%. That was the time to be buying. And then another really good day on the 19th of February, up 17.7%. So a couple of really good days for Rigaku. The chart is looking good. Can't tell you why, but the chart is looking pretty good. And I love that volume, big volume. If we go back to the previous one, which was BE, there's nothing that drew me into the volume except for where it started to break out. So there was some high volume at that point, but the volume has sort of maintained and has been subtly decreasing. So that could be a little bit of negative sign, but the volume in 268 has been really good. Happy now. Thanks for another video. I had to play certain bits multiple times, especially the bit where you haven't been following the war in Iran, just to make sure you said that. Gosh, especially when you said a little bit of fear. While I can't state the fear factor on people and their tolerance compared to a seasoned investor like yourself, what I do know for a fact is that rebuilding a leading oil refinery doesn't happen overnight, especially when missiles are falling from the sky. I don't know how many leading oil refineries have been impacted, maybe not all that much, but I do think there is a chance now, a bigger increased chance now, the supply of oil will be disrupted for at least a limited time, which will push up the oil prices, and we're already seeing that, particularly if this conflict is protracted. But I also believe, significantly believe, that Trump doesn't want that. Anyway. Okay. Interesting on EZZ, as I'm almost certain this was value at much higher rates many moons ago, and many followers bought in. How times have changed. Yeah. So Ben Hutchinson also mentioned disappointing results reveals their core business engine in China is deteriorating. So this is one of the reasons why I sold out of EZZ, or why, even though it has looked really cheap and good value, I wasn't liking their reliance on China. This has not worked out well for many companies on the ASX, being over reliant on China. I do like companies who diversify. We're seeing that with Treasury Wines now. So Treasury Wines was in love, obsessed with China. And it seemed like EZZ was obsessed with China, which is the reason why this was not a long-term position, just a trading position. And a long time ago, the chart for EZZ turned negative. So I have barely looked at this company since then. I did have a quick look at their results and I was like, whoa, this company's fallen off a cliff, it seems like. Anyway, the past couple of years, they've generally been very profitable, but it looks in peril. I struggle to believe the pivot away from China would succeed because their vitamins seemed high-priced luxuries and thus uncompetitive in more open markets, but I did expect they would succeed in China for longer. I still rate the CEO as a canny business person. And there's the other thing. I had a look at some of their products. I was like, I'm not sure why people buy this sort of stuff. That's just me. That's just me. I don't really fall for gimmicks, and that's the way I looked at EZZ products. It just seemed like a lot of their products were gimmicks, but people were buying at that point. So I'm just going to have a quick look at their results. I just remember looking and going, yeah, that's pretty crappy. Now, I might have said that when they released their pennies 4C, but I can't honestly remember it at all. So I'm wondering if, yeah, that's right, they were highly operating cash flow negative. So this company was really positive not that long ago, and just things have just gone off a cliff for the company, hasn't it? And the other thing I remember, their advertising marketing was much lower. So they really ramped up their advertising. No, wait there. No, that's right. They always had high advertising and marketing. It was their product manufacturing and operating costs that were quite low. This company had really high gross profits. And I'm wondering if the gross profits are starting to drop significantly. And in fact, we could actually find that out. I'm just going to go back to the most recent, the most furthest back to pennies 4C I could find in ComSec, and just have a very quick look at. In fact, this one is really good. They had, in one quarter 2 years ago, receipts 23.6 million, in operating cash flow positive 2 million. Receipts have halved. I suppose their 22.6 million. I suppose their gross profits have remained the same. Advertising and marketing have increased. So they actually increased their advertising and marketing expenditure they decreased it. Sorry, I was looking at the wrong one. But they're not halved it. So they have decreased advertising and marketing, but at lesser rate than the decrease in receipts. But it seems like the gross profits are about the same than 2 years ago. But yeah, a few years ago, this company was producing a fair bit of cash flow. Not anymore. In fact, let's have a look. EZZ. And what I'm going to do, since it's up here already, is we'll get rid of that and we'll put in cash flow statement, operating cash flow, and free cash flow. And this is on a yearly base. Yeah, a few years ago, in fact, the last few years have been nice, have nice operating and free cash flow. And it looks like that is turning negative. Let's have a look at the chart for EZZ. Oh, this is a negative chart, isn't it? Oh, it's broken. It's broken down below a support level. So the time I was trading this was back in. God, wasn't that long ago? I thought it was not. I thought it was earlier than this. So this was back in 2024. Yeah, I thought it was much longer ago than that. And the chart back then was a gorgeous chart, beautiful chart. I bought. It would have been well before a breakout. So I bought this on the potential, and I would have bought this probably in September, sometime in 2023. And the share price went bonkers in 2024, hit a high of $5 almost. And then, yeah, that was it. And now the chart looks terrible. In fact, the last time share price was this low was back in middle of 2024. Anyway. Jay Lanks, anyone else confused over the prices Kneppy quoted around 280 for GenusPlus? If I said GenusPlus was a share price of 280, complete mistake. And evident on the y-axis on his chart compared to a chart brought up at home along with the ComSec quoted closing price 821 shown in Kneppy's video. Now maybe I bought at 280. Let me have a look. Because, yeah, GenusPlus share price is well above. Now I bought at $1.39. So I don't know why, if I did say 280, that would have been a mistake. I don't know why. I don't have no idea. Sorry about that if I did make a mistake, but I'm human and I can make mistakes. If you're not human and you don't make mistakes, that's something else. Ben Hutchinson, I think the bounce in Austin Engineering is largely that two directors have bought on market in the last days, the CEO putting up $100,000. So this is another case. I think Ben Hutchinson does follow directors' transactions based off two comments in this video. So Austin Engineering had a nice little bounce, but I'm not sure if we're going to see a continued, or this the low. I'm not sure. His share price down 30% on the 26th, then a nice bounce. And let's have a look at, where is it? Director transactions. Let's see when it shows up here. There it is, Austin Engineering. Cy Van Dyke and James Walker bought a fair few shares at about 19.5 and 20 cents. Definitely Sinbrandt Van Dyke. And yeah, about 20 cents. And if we have a look, it's not a lot, $100,000, but if we have a look at the chart, so yeah, at this, I do think it's at interesting levels, but the question becomes, when do you buy? If you want to buy, when do you buy? If this is, you think, the bottom, and if we do, we continue to see some directors buying, that actually would be some good things, good signs, some good green flags moving forward. Now, the reason I'm talking about this, about Austin Engineering, is because I do think this company is a really good potential trade, particularly if things turn around. And I do think there could be some value. Ben Hutchinson also asked, did I retain some Pioneer credit? No, I did not. And they did upgrade guidance. Yes, I thought the share price would go up more, but I think it's a reason why they upgraded. It was just something to do with some financial notes or something. So I think that's why the market didn't react quite as strong as I thought they would. Just because when you see profit up guidance increase to at least 23 million, I would expect a much stronger response from the market, but it was just a repricing of its 55.5 million medium-term notes. Yes, I think that's why the share price has not rallied all that much. So it was nice volume on the day, but definitely back on my watch list, but have not bought back in. The weekly chart looks really good. So if you have a look at the different time frame, it does look much better. But I do think if you are trading on the weekly time frame, you have to be a little bit more patient than I've been in the past with Pioneer Credit. So the weekly chart looks pretty good. Daily chart, a little bit more noise in the daily chart. But I couldn't envisage the share price of this one going up from here. Kelly Ma. Hi, Kneppy. Is GQG Partners a breakout today? What are your thoughts on its charts? Also, what are your thoughts on the chart of EIQ? It looks like a breakout today. Thank you. So let's have a look at GQG and EIQ. GQG, they've been in the news lately because they sold out of all their tech stocks a while ago, thinking they were the best. And yeah, so that's why they've been in the news lately. So they thought not much profits in tech stocks or something like that, but they did underperform the market, even though they weren't in tech stocks. And tech stocks have underperformed them. I don't understand it. Anyway, so GQG. So this is, in a way, I was going to say double breakout, but I don't know why that. There it is. That's better. For some reason, that line moved. Can't. There we go. So there is a downtrend, a long-term downtrend for GQG going all the way back to, come on, move. There we go. There we go. We got it now. Going all the way back 2 years. Share price has been below that trend line during that 2 years. That's why it's a trend line. Most of the time. It was once or twice. It just got above it, but did not stay above. Anyway, so for me to consider this a breakout, I need to see the share price get above that trend line. That's a consideration. But the share price did get above this little resistance line at about $1.88. And that means the share price is at least a 6-month high. In fact, more than a 6-month high. So this is sort of like, maybe not a mini breakout, but definitely you could argue this is a breakout. And if we had this breakout from this resistance line, and then the share price also getting above the downtrend line, that would be a confirmation of a breakout. So yeah, I think you consider this as a breakout. I think you could consider this as a breakout. EIQ. Echo IQ. I wouldn't consider this a breakout because the share price has been in an uptrend for a while. So for me, a real breakout is when a share price has been not doing much, maybe going sideways or going down slowly, and then all of a sudden the share price pops up on some good news or something, preferably on good news, and the share price gets to a new high. That is, in my definition of breakout, this is just continuation of a long-term up, maybe not long-term uptrend, but continuation of uptrend. Now, the breakout for EIQ would have been probably around about middle of January. Yeah, so somewhere in the middle of January when the share price was between 30 and 38. So the real breakout, if you really want to be technical, was when the share price got above this high in May, or you could have even argued when the share price got above the highs in September. So that would have been on the 13th of January. So around about 32 cents. So for me, that's a real breakout. We're just seeing continuation of the uptrend here for Echo IQ, and the chart looks pretty good. And here we are, Michael DJ also mentioning photo back in bottom left or diminished width. I work with someone called Width, WIDITH. And whenever I see the word width, I think of width. Anyway, and leave it where it was, agree 100%. Or diminish width and leave it where it was. So bottom left, is it thumbs up? 2 thumbs up, bottom left. And finally, Capel Septh. Would love your comments. Oh, no. Would live or live your comments on Steadfast and AUB Group. Would love. Okay, so I do own Steadfast. And I do think, this is just my thoughts, there are fears that, and I've heard this on Osby's The Call, I wouldn't be buying Steadfast or AUB Group because AI is going to disrupt these companies because you don't have to go to an insurance broker anymore. But there is a bit of a flaw in that reasoning right now. Maybe long term this is true. Maybe long term it is true. But there is a flaw with this reasoning because I have never been to an insurance broker because I do all that stuff myself. And those people more likely to go to an insurance broker are much, much, much less likely to use AI. So they'll keep on going to an insurance broker. That is the way I look at it. So I think these companies won't be affected by AI for a while. And in fact, they could be beneficiaries of AI. They could streamline their businesses. They could see profit growth above what they've been experiencing because of AI. So I do think their fears in Steadfast and AUB Group are probably overblown. And the other thing is, these companies look really good. Value. What do I mean by value? Let's have a look. Let's do it. The charts don't look good, but let's have a look at Steadfast and AUB Group. Do they look good at value? Okay, so this is AUB Group's operating cash flow and free cash flow, climbing nicely. But when it comes to value, I'm just going to look at P/E ratio. Oh, this is one-off. So this is why I sometimes include other metrics. What about the free cash flow yield? So the free cash flow yield of AUB Group is at 10.74%. The last time it was this high, and what you want with free cash flow yield is a higher number, is better. So low number is worse. That's what a yield is. So you're getting like your free cash flow is your profit, no, your valuation is 10 times free cash flow. That's not that much. Anyways, the last time it was this high was back in COVID-19. It has been as low as 2.6%, 4%. So you can definitely see that AUB Group, based off this one metric, looks pretty good value. I'm just going to have a look at EV to EBIT. I would assume this is looking really good as well. Yep, and this is where we want to look at how it compares on the low side, and it's never been this lower in the past 10 years. The lowest it got was during COVID-19 when it was 12.7, now it's 8.9. So AUB Group looks really good value. Don't own, actually wait there, this is Steadfast. Steadfast looks really good value, and even though the chart looks terrible, I'm more inclined to buy more shares. Now, what I'll probably do now is just wait for a breakout for Steadfast and then buy shares. So just wait for that breakout and then buy shares. What I could have done is not buy shares and just wait for that breakout. Yeah, could have done that. And I have a feeling if we have a look at AUB, it's the same thing. So this is AUB's EV to EBIT. Oh, not quite. So it's at 14.2. And if you go back to 2018-19, this is at these levels. And what we might do is have a look at the free cash flow yield. Yeah, it's not as high. So just based off these, really simplistic view, rough view of these companies, Steadfast does look a little bit more attractive in the AUB Group. And if we go and have a look at the P ratio of both companies, both look really cheap. So P ratio of AUB Group is 15.8 with pretty nice growth. And Steadfast is 12, 13, I think. 14.3. I think it was 12. I'm pretty sure some other places it says 12, 13. Let's have a look. P ratio, in comps, no, that's the wrong company. I was going to say. And ComSec P ratio is 12.71. Yeah. And even dividend yield's pretty nice. 4.5% dividend yield with a company that's growing. And I don't think this company won't stop growing anytime soon. Does look attractive. Okay, that is all I have for this look at your comments and questions. If you have any questions, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.